Hey yo, what is up dudes and dudettes? This is Due-Diligence here. And while we're solving our Google search or YouTube search problems with our channel name, we might need to change our name so the algorithm can pick up a lot of if you put in due diligence into the search bar, sometimes it doesn't come up unless you do hashtags, right? But anyways, today we're gonna get into the content of a merger. So today we're going to teach you something called risk arbitrage. How do you make money when a merger announcement coming out, and how would you bet on both sides to have a cumulative positive return at the same time? Well, you get to see some cute gaming photos like the lady over there. And then, that lady looks really pissed off, but hey, it's still cute, right? And then let's look at the business combination between TTWO with Zynga? Well, basically the studio or the company owns the studio that did Farmville. Alright, let's get into it. So, before I get into the very business central finance stuff, or I will just give you guys a rundown of what you're supposed to do when a risk arbitrage situation come up. First, we got to introduce the companies, right? So the acquirer, which is the one who's spending money, cash or share, or the combination of cash and share to acquire another company, is TTWO, which is a significantly bigger studio who owns multiple brands like GTA, right? Where we get all these hot chicks from. Oh, yeah. And then the other one, well, let's move on to the other slide. So who is Zynga? It's Zynga. Okay, this company is basically a mobile developer who does, let's just say, games like this one, Farmville 2, that essentially you play, all these kids plays mobile games and the adults do that. Yeah. But, they have a slightly smaller, well, significantly smaller market cap because they are only operating on the mobile platform, or their major revenue drivers are on a mobile platform. And, if you put a hot chick like that one on a mobile games like that, it doesn't look that great. But TT2 or Take-Two Interactive, which is the parent company of GTA, they want to make a GTA mobile game. And we see this mobile transition starting or take over the entire gaming industry starting 4 years ago when Activision Blizzard, I think it's 4 years ago, 3 years ago, somewhere around there, decided to acquire King's Game, which is a mobile developer. Therefore, we can literally play this merger as if we're playing the Activision Blizzard merger there, or acquisition there. Therefore, but the thing is, the terms in these merger agreement are a little bit different. Therefore, the strategy we're gonna use in making money in this deal is gonna be slightly different. And because the market condition is a little bit different, so there's some risk involved here that's higher risk than other risk arbitrage situations. But, keep tuned and I will let you know what you need to know. And for those of you who just want a sum down of, generally what you gonna do if you see merger announcement like this, I'll just highlight it in the first section of the video. And then the second section of the video will be a little bit in depth. And then the more in-depth strategy will be provided on Patreon chat, or any of the Patreon members see this. You can ask and I'll give you guys the rundown and specifics of that. But for the general video here, it's just going to be very simple. Again, we're not financial advisors. We do not give financial advice. Everything we say on the channel is for shits and giggles only. Okay guys, before we explain how we're going to execute the trade to make it most likely very profitable, if you see those merger deals, you probably have like a 75% edge that this risk arbitrage situation or combination of trade is going to work out. The reason is that, so what risk arbitrage literally is in a merger, you have an acquirer and an acquiree. Acquirer is the person who's going to buy the company, and acquiree is the person who's going to get the company. And whenever you buy a company, usually the person who's offering shares or cash, the company who's being bought, they really pay a premium, right? What is a premium? It means, okay, let's just say DD, right, me, number 2 is the partner of this channel, decided to, we own the company and we decided to buy out, let's just say, I don't know, who is a good one to buy out? Let's just say we're going to buy out, I don't know, I don't really want to buy out Sterling's channel. What is a good channel? Charlie's video. I really like the stuff that they're making. Let's just say we're going to buy out that channel. And let's just say that channel worth $1 million. But because we're the buyer, right, we want to make, the people who, the company we're going to buy, the shareholders happy. Therefore, we always pay a premium. So let's just say we pay a $2 million for $1 million worth of company. Like on paper, it's worth $1 million, but when during the transaction, it worth $2 million because you have to pay $2 million. Therefore, you're paying 100% premium. And how does this 100% premium works is because you paid basically in the head of a regular investor or shareholder or a finance guru like us, what we see is you spend cash right now, right? You spend cash, and then the cash value is not going to be significantly realized or in a very short period of time. Therefore, during the merger period, when merger are announced, your stock is most likely to go up as the acquiree because you're going to get paid, right? You're going to get paid way more than your actual share price. Therefore, that makes sense. So in this case, Zynga, the Farmville developer, their stock's going to go up to the point where it's going to reach the almost close to the acquisition price. And then for Take-Two, what's going to happen is initially it's probably going to drop a little bit. Their stock price is going to drop depending on how much they're paying the other company for cash. And then depending on the market conditions, there might be some volatility adjustment going on. It might rebound. But its actual price is going to actually go down. Why is that? Because they spend money, they spend cash that, if they don't acquire something, those cash or auto-generated or in a investor sense, they sort of pays a distribution to investors as dividends or whatever, right? Therefore, the general shareholder value of the acquirer company is going to go down. Therefore, how would you play this is you will short the acquirer and then go long on the acquiree. This is exactly what we did, but because of the fact that VIX actually piled up, we don't want to talk about the volatility here. I mean, we basically got the Zynga one right, and the other one, I'm pretty sure Take-Two is gonna drop after a temporary shoot up based on market volatility and everything else. We're gonna do an update of this merger deal in about a week and a half and see if we were right or not. So basically what happens is on the bottom, you will see the acquiree's company. You see it will have a general spike up period, and then on the acquirer, you will see a general going down period. And then what's going to happen is when merger close, the both value of the company will combine and it will flatline the entire process. So there's a invisible line at 10% here if you do the average. And because due to the fact that we are at a pivot point of economic history, and we might see an interest rate hike, and we might see a more than expected interest rate hike. Therefore, the acquirer stock is going to be generally very, very volatile. But in general, in the long run, it's going to go down by the amount of premium that they pay for the acquiree's company. All right. So here is the technical part, which some of you like and some of you do not like. We actually see this playing out in action. So on the day of announcement, Zynga actually went up by this much, right? And then as regular investor, you probably can observe this during pre-market, but you cannot really cash in for this. And then your actual upside is when whatever it opens up over here to the price, the merger acquiring price. And my subscribers has been asking me for the past few days that what do you think the price of that Zynga is gonna be? I was like, okay, I'll just show you something, okay? So how do you check what price Zynga is gonna be? Well, first of all, you go look at the 425 on SEC. And then, well, let's not go ahead of ourselves. So basically, the term of the merger is our GTA boy decided to buy this mobile platform or mobile developer for 9.86 per share. Okay, and then 3.5 of those 9.6 is going to be dealt in cash, and then 6.36 is going to be a dealt in share. And for those of you who are still confused, how does this gonna affect you if you're holding Zynga right now, or if you're holding call options of Zynga right now, whether you should exercise? I will make another video if this video got a lot of likes or got a lot of views, and then I will tell you what are some general strategies you can deal with all of the shares that you have on hand, and what are some futures that you can proceed. But just for this purpose of this video, I'm just gonna tell you the top where the stock of Zynga is gonna flatline is at $9.86, which is right here. Okay, and a lot of you are saying whether there's gonna be a squeeze or not, right? Well, in order to determine whether it's gonna squeeze or not, we have to look at the option chain. And then because due to time limit, I'm not gonna look at the option chain, and because usually there are a lot of firms who does those risk arbitrage things, therefore they usually would exit right on top of the acquiring price, which is $9.86. That means whenever the stock hits $9.86, it will just flatline, and some of them will start selling off their shares in different format. There are a lot of ways it can do that, but it will probably flatline at 9.86, and it won't go up. It won't go up because during those mergers, a lot of those market makers are hedging these trades really, really well. Therefore, unless it's like a penny stock pump and dump merger like MMAT or very, very meme stocks, it's not really going to happen. The probability of having a gamma squeeze is actually really, really low. Consider the closing date of the merger is actually on the first quarter of fiscal year of 2023. You can actually see it over here. Without getting into all of those, nitty gritty details, you guys probably don't want to know or don't care. You just want to do a quick trade. What you can do is you can still buy call options for Zynga. You can still buy or hold a call option for a little bit and wait until it flatlines at 9.86, and then you probably want to exit. You probably want to exit before that a little bit. So your upside is actually pretty small, but then your upside is actually really, really certain. Why? Because think about it, right? If another company is coming in and then buy us out, that means our original stock price is at $5, and then your buyout price is at 9.86. As a reasonable investor, they will start buying this, right? They will start buying this stock until it reaches $9.86. Therefore, that's it. That's the logic. This is where this stock's gonna go. And then for those of you who are interested on the shorting side, it actually makes sense. Well, the only problem with this shorting play here, which we're bleeding a little bit on here, is because on this specific day, right, when there's merger adjustment will happen. And the merger adjustment, we also did a calculation. If you guys want the detailed calculation, comment down below, like this video or whatever. We actually did a really detailed calculation on how much the stock will go down. Our targeting price at $50, and apparently on the first day we reached a market volatility, reverse volatility eat up day, which is the day where the market drops a lot of points, and you guys are like, oh my god, the Armageddon is coming. And then me on Patreon is like, nah, tomorrow is probably gonna rebound, have like a higher thing, and it's probably better to leverage up a little bit there. You make a little bit of profit. But anyways, those are just another story for another day. But for this thing, it's probably gonna rebound up to 160, and then it will probably go down. Why? Because these hard merger deals doesn't close immediately. They have during like the merger combination period, they still have to do further due diligence and further, like, there are a lot of auditing stuff going on. There are a lot of business transaction stuff going on that need to be finished, and then the stock will just cool off all the way until about a month or 2 months before the merger close day. Then you will see another spike up on this stock. Therefore, this stock will generally go down in the next few weeks, and then Zynga will also, well, Zynga will probably just flatline here. It will just flatline at 9.86, and that's it. And it will be really, it's actually really safe to just exit when it's at 9.86, unless you want to take the deal where it gives you $3.5 per share on top of the share value you have, and then you will get the another $3.3 worth of stock out of take two. But that will be scenario number 2. But this one, I've already explained, and hopefully you guys understand it. If you have any questions or comments, just comment down below and like this video. This is going to be a series of me just talking about basic financial education, and there are literally like a lot of those. Risk arbitrage is literally a way that it's an event-based interaction, like an interactive way that you can trade to like basically make a profit like 75% to 80% of the time. And I will give you guys the other method or other things. Basically, those are trading on information, not really trading on statistics or trading on TA. And those are pretty reliable. There are over like 40 funds does this in the United States, and majority of them makes money on those deals. Therefore, you will see a very structured deal, and then usually the upside and the downside on a specific day, for example, on the merger day, is around 5 to 7%, which I think is pretty good in terms of like a short-term gain. Anyway, this is it for this video. Hope you guys love it. See you guys on the upside.